good morning, everyone, or good afternoon, depending on where you are. My name is Joe Mulcahy, and I am the TPA RPC for the Western US. And so if I haven't met you before, I've been with Capital for 5 years, and I'm based in San Francisco, California. And it's definitely an honor to be here today. I know we're virtual, but it'd be great if we could be in person. But that being said, I'm really excited about this topic today. We're here to talk about prospecting. And whether you do 2 plans a month or you only have a couple plans under care, the hope for today is that you get a lot out of the resources we're going to share with you today. I'd be remiss if I didn't say thank you. At American Funds, we record keep 60,000 businesses. That's 2.4 million participants that are relying on our record keeping platform. We couldn't do any of this without the good folks at Definity and, of course, the good folks on the phone as well. So I just want to say thank you. Before I jump into my agenda, I would like to highlight the amazing opportunity that's in front of us. Think about Secure Act, the proposed legislation coming down the pike. Our industry leaders estimate that these drivers are going to generate 1 million new businesses, 16 million new eligible participants, and 625,000 new plan sponsors looking to add a 401k. In addition, if you're in states like mine in California or Oregon or Illinois, there are also state-sponsored mandated plans that are giving a push as well. I think the bottom line, there's a lot of opportunity. And so for today, I want to spend my time in 3 real key areas. First, I want to show you how winning 2 plans a year can really add up over time. Secondly, I wanted to walk through the 1 meeting close sales process. And then third, provide an overview of our target date evaluation tool. So let me jump in here. I think we can all agree that the retirement plan business has attracted sticky assets. Whether we're in good markets or bad markets, participants, they tend to invest and stay invested. Case in point, I think about CARES Act, the loans and distributions. American Funds, we're expecting a lot more requests than we actually received. In addition, retirement plans also serve as gateways to ancillary business like 529s, IRAs, rollovers. Many of the advisors that we work with realize that to have a balanced practice, it includes both retirement plans as well as retail business. Now, the example on the screen here in front of you illustrates what adding 2 plans a year can do to your overall practice. We made a couple assumptions here as well. And so we're thinking 2 plans a year, 1 takeover, 1 startup. And assuming that the takeover is 2.5 million in assets and 30 participants with 100 in flow, if you follow that strategy and add those 2 plans every year for 10 years, we're talking about a book of business with roughly 20 plans, 60 million in assets under management, and 600 retirement plan participants. Now, if you're looking to make retirement plans part of your business, this measured approach is actually easier than you think. Now, for the folks on the phone who are focused on plans, maybe you do a couple plans a month. Earlier, I stated that retirement plans can lead to 529s and IRAs. Well, take that scenario and let's reverse that. And here's a quick sales idea. Lead with the 529, and sometimes that can offer an inroad to the actual 401k. And because the benefits of the 529, there's no setup cost, there's no upfront fee for the participants, and it can be turned on right away. So again, lead with the 529 and then win with the 401k. So I'm going to advance the slides here, and we're going to switch gears and talk about takeovers and benchmarking. Now, this slide is called the art of the 1 meeting close. It's one of the most requested pieces that we have in our extensive retirement practice builder library. We know that when plan sponsors put their plan out to bid and review a plan, they're really concerned with 3 areas. Are the fees reasonable? Do they have the right funds? Are the services in line with what the plans need? And so fees, funds, and service. with the right tools and really good support, it doesn't have to be that complicated. In fact, many of the times, a lot of the heavy lifting when you're preparing a plan can be done ahead of time. And that's why we call this the one meeting close, which basically is a step-by-step process that involves 5,500 prospecting using Brightscope or the DOL search tool, making contact with the key decision maker, and then of course asking for the fee disclosure. Now, I'll kind of pause here for a second and make some comments on Brightscope. All the Brightscope data that's in that service is all driven by 5,500s. They do, however, have a proprietary algorithm that they use, and so it assigns each plan a score, and then it highlights where the plan is either doing well or where the plan is falling short. And so to give you an example, it may look at the fees on the plan and may compare it to the benchmark and say, well, those fees are kind of high compared to the benchmark. It may look at participation rate, maybe it's low. It even looks at the investments. Maybe the plan is overweighted to one particular fund, or there's too much money sitting in money market. And so I'm sharing this with you because as an advisor, if you went to the Brightscope public site, what you would find is that you won't see any of those tools available. You actually have to pay for that part of their service. So one best practice would be reach out to your American Funds internal and external sales team. We have access to it. We pay for that service. Ask us to run the report. So imagine you've got a prospect, you've gathered all that information ahead of time, and you haven't even spoken with the client yet. It's pretty powerful. So if I can go back to this piece on the backside, I want to talk about fee disclosures for a second, AKA the 408B2. So if you don't know, this document has everything you need to benchmark a plan. The challenge with the fee disclosure is that usually the plan sponsors have no idea what it is. They don't know where to find it. And to complicate things even more, each record keeper calls it something different. So to make life easier, and it's a little bit small, but that gray box right there lists all the different record keepers and all the different name variations. So it's a little cheat sheet for all the fee disclosures. So once you have the fee disclosure, easiest thing to do is send it to us. We can run the cost analysis. And then what we'll do is we'll put out a report, and you can see in the top right corner, there's a little sample. If I advance, you can see a zoomed in version. We'll create a comparison that looks just like this. You can see it's in grid format. We've got the columns side by side. We put the bottom line fees at we put the fees right at the bottom line. And what's nice about this, we can compare their current provider to say another proposal. We can even compare it to the 401k book of average. So again, back to the fee disclosure. Again, you don't have to go this alone. We can run the report for you. We can co-present right next to you. Now, full disclosure on the cost comparison, it looks at the fund menus, it looks at the expense ratios, but it doesn't evaluate the target date series. And I know Tom mentioned that before. That's one of the tools that we have available. We call it ProView. Now, if you navigate to our website and type in ProView, you'll see that the third option down, if you click on that, it'll bring you to this landing page right here. And a couple comments on this. This really is a fast, easy way to analyze all the available target date series that are out there, including CITs. What it looks at is glide path, risk, returns, and all of the data is powered by Morningstar. And to get started, all you have to do is click that blue start button, and then you can pick up the 4 different target date funds. The nice thing is you don't even have to include American funds. You can choose any series that you want. And what you'll end up with is a cover page like this. And no, your eyes are not deceiving you. It's intentionally meant to look like this, as unbranded as possible. In fact, you'd have to look really hard to even find the American fund's name. It's down there in the bottom in the disclosures. You can, however, as an advisor, customize this with your name and your address. But again, we wanted it to be as unbranded as possible. Now, if we go into the report and we look under the hood, you can see we start with manager profile. We're looking at assets under management, inception date, the percentage that the series is active, to versus through, and then manager tenure. Now on the right side, that's the quartile ranking by vintage. We call this the champagne chart. Think about the bubbles, all the bubbles rise to the top. Now, quick disclosure as well, for the purpose of this presentation and brevity, I just grabbed screenshots and put it into the presentation. This report is a lot more extensive. It's filled with more detail. There's additional explanations. There's a whole appendix that explains all of the different charts like capture ratio and Sharpe ratio. Because this is client approved, we have all those explanations. But again, just to give you a snapshot, I used the screenshots. One thing I will note though, is that if you do run a CIT comparison, that's not for public use. So, and one other comment, there are some broker-dealers that are restricted from using this. So before you send this to your client, I would go ahead and check with your broker-dealer to make sure you can send it out. But back to the evaluation tool, moving down some of the data, you can see that it looks at risk, but the real story is on the right-hand side. It's the charts with the different variations of purple. When you look close, you can see how each manager shifts the underlying assets with varying degrees of volatility. They do this to manage the risk as the participants move down closer to retirement age. On the other hand, you can see which series, they don't make any changes at all, or they're more static. And to give you a real life example, if you look at our target date series, you can see as the participants enter into transition and distribution, we de-risk the plan on the equity side. On the other hand, you can see that we make adjustments to the fixed income with really 4 goals in mind. We look at diversification from equities, inflation protection, income, of course, and capital preservation. Again, this report, there's a lot of data. The best practice would be to let your American Funds team run the report. And then the next time you've got a prospect or investment committee, let us know, and we'd be happy to co-present right alongside you. Now, I've seen this report used as a standalone. I've also seen it used in conjunction with our cost comparison. Just like we discussed earlier, using the 529 to win with the 401k, you can also use the target date evaluation to show your value and then lead you to the 401k. Now, the bottom line is that 90 cents of every dollar contributing to 401k plans right now, it seems to be flowing to the target date funds. And I think it's 2030, by 2030, 80% of assets in retirement plans are going to be in the target date fund or the QDIA. Having a report like this is really critical, especially to getting it right. And so to do a quick recap, we covered how adding 2 plans a year can really add up over time. We walk through benchmarking a plan. It doesn't have to be that complicated. And of course, we focus on the target date funds. Having a turnkey solution to evaluate target date funds will help you win and retain plans. Now, I hope this was helpful. Let me see if there are any questions. I don't see Q&A. No questions here. So let me pause here and I will turn it over to Carolyn. And I just want to say thank you so much for your time and sorry for that interruption when I lost my internet. But Carolyn, the floor is yours.
Carolyn, before you jump in, I do see a question from Drew. Joseph, that I think you were talking about the fee disclosure names by company. That is part of that one meeting close advisor support piece, is it not?
That's correct. So yeah, the cheat sheet is in the gray box, and we can certainly follow up and send that piece out to you. It lists over a dozen different record keepers. It has the specific name for their fee disclosure, so it is included.
Awesome. And then I thought you may touch on a little bit of the different solutions that you have for those advisors who may not be super familiar with American Funds record keeping, or just with Record Keeper Direct. Do you mind touching just on a little bit on your two options and maybe where you see more more clients depending on their size honing in?
Yeah, I certainly can. And so at American Funds, we have two solutions. We have a small business solution, and then we have a larger plan solution. And so our real bread and butter is our smaller plan solution. It's called Record Keeper Direct. Typically, a client that has a startup or has assets less than $1 million in assets under management, they make a good fit for Record Keeper Direct. Couple of reasons. It's simple and easy to maintain. It's one fund family, and it's on the lower cost side. Very cost effective. What's nice about Record Keeper Direct is everything's done in-house, meaning that you're going to call in, you're going to talk to American Funds associates. The average tenure of our associates is around 12 years. And again, Record Keeper Direct is our small plan, small business solution. And as you move up the spectrum to say $1 million or more, that's where Plan Premier starts to make more sense. You have access to outside funds. There also are some more services available because it's a more robust platform. But again, from a cost perspective, it makes more sense for plans that are $1 million and above. There are built-in credits to help offset some of those costs depending on share class. But again, I've seen it used for a startup, but only in certain cases. And that's kind of a broad overview of the two solutions that we have.